How's it going? I'm in the money, and today we're talking about technical analysis. Technical analysis, put simply, is looking at a stock chart and using whatever clues the stock chart can give you to identify trends and identify them as early as possible. The earlier you can identify a trend, the earlier you can hop on. You can buy if it's an uptrend or sell if it's a downtrend. The longer you can hold and the more money you can make. Technical analysis, or a TA, as I'm going to say, because I can't say technical analysis over and over. I already butchered it. TA is valid because it is based around identifying trends, and trends are inherently identifiable. The fact that you can look at a section of stock chart and know whether it's in an uptrend or a downtrend means at some point during that trend, it was identifiable. For an uptrend, it might not be identifiable on the first green triangle, but is it the first four, first five? You know, what does it take? What kind of patterns must form that at a certain point it does become identifiable? If it's identifiable now, then at some point it wasn't, and at some point it was. And so because that is possible, it means that you can identify trends at a certain point, and if you can identify trends early, then you can make money. That is the simplest idea behind technical analysis. Now, there's so much that goes into technical analysis. There's so many different ways that it fractals out into a bunch of different strategies. What we're going to talk about today is purely from my perspective. It's not from a textbook. It's from a little bits of pieces of information I've picked up over the last 5 years. And it's not going to cover everything. There's just too much to go over. So I'll put a bunch of links to helpful information in the description below, and also just grab some free stocks while you're down there. Okay, buddy? Follow me on Iris. Thanks. Okay, so we have identified that TA is identifying trends and making money by doing so. And the fact that stocks travel and trends gives you your edge as a technical analyst. If you were a full adopter of the efficient market hypothesis, which states that current stock prices represent and price in all available information to the public, then TA would not be valid. The efficient market hypothesis assumes any move that is not given to it based on new information is a coin flip. There's a 50% chance of going up, 50% chance of going down. For TA to be valid, you have to believe that markets are not perfectly efficient, that people do not trade unemotionally, and that people maximize rational utility and make rational choices. While sometimes stocks might reflect the efficient market hypothesis, I think we can all pretty much agree that a lot of the times they do not, and that there are inefficiencies in the stock price that do not reflect the intrinsic price of the stock that can be capitalized on and closed. But when markets have more participants, those inefficiencies become fewer and fewer. So it's been harder and harder to make money through technical analysis over the years, especially as more people have swarmed into the markets and as algorithmic bots became a thing. Still, though, there is this idea of herding behavior, that people are constantly chasing each other and each other's ideas and trying to figure out what the other guy's thinking, or what they think the other guy's thinking about the other guy. And so you'll see this herding behavior that repeats across time on a stock chart that you can use to your advantage. Okay, let's look at a stock chart and look at the big picture, and we'll start zooming in so you can actually see how technical analysis even works. All right, here we're looking at the Qs. All right, QQQ, it's a NASDAQ ETF. What do you see here when you look at this? What trend? It's an uptrend, right? A 5-year-old could look at this and go, "Daddy, it's going up." And you'd go, "Get out of my room, I'm playing Fortnite." It's going up. So the fact that we can identify it's going up means that at some point it was identifiable at some point prior than this exact moment. And if it's identifiable before this exact moment, that means we could have gotten in on this ride earlier and made some money. Now, how did we identify that this isn't an uptrend? Well, two things. One, we look at where it started, and we look at where it ended. That means it's in an uptrend if it started lower than it ended. However, it's entirely possible for a stock to trade sideways and zigzag like this, yet it starts right here, zigzag sideways, and ends right here. That doesn't necessarily necessitate an uptrend. It's trading sideways. It's consolidating, which that's the term for that. The price is consolidating at a level, and yet it started lower than it ended, and it's not an uptrend. So while it's starting lower than where it ended is an idea of giving you, telling you it's in an uptrend. Another key thing to identifying uptrends is looking at the relative lows and relative highs of the stock price, or in this case, the ETF price. So let's zoom in a little bit here on a section. On this left side, we can see that it was in an uptrend. It started low, it started high, it's not trading sideways. And if it's not trading sideways, but it's heading up, there's one thing that has to be there, and that is higher lows and higher highs. If we look at these relative lows, when I say relative lows, it's relative to the time frame we're looking at, you can see that the lows keep getting higher. The lows keep getting higher, and if we look at the relative highs, the highs get higher as well. It's just like a staircase going up. Higher highs and higher lows are indicative of an uptrend and are very useful in identifying trends early on. If you saw this high, then this low, then this high again, and then this low, you'd be like, well, shoot, we've had one higher low, we've had two higher highs. It looks like it's in an uptrend. It dips. Well, maybe now's a good time to buy. Well, you just utilized technical analysis in your favor to make money. And if you bought and held, you could have made money if you sold at the right time. Now, the part of what's tricky about technical analysis is deciding when to sell and deciding when the trend's changing. In this case, it's pretty apparent, right? We have higher highs, higher lows, and then when the trend starts changing, what happens? It stops moving upwards, it starts trading sideways, and something very important happens, and that is that the stock price hits a certain price twice. What does that mean? Stock prices are driven by supply and demand. If there is an excess of demand, the stock price moves upwards. That's how it is with anything. If there's more buyers snatching at something, trying to buy something, than there are sellers selling that thing, the price is going to go up because the sellers have more people to sell to. People keep snatching up the stock at a certain price. They can start raising the price, or the people who enter the price too low, those orders get filled way too quick, so they start disappearing and the price starts moving upwards. So when demand overwhelms supply, it starts moving upwards. What happens when demand matches supply? The stock price stays the same. What happens if supply is higher than demand at a certain price? It means that if people really, really like selling at a certain price, every time that demand overwhelms supply, as soon as it hits that price, supply starts overwhelming demand and it'll start going back down again. That's exactly what happens here. We can see on the price level of around 187, 188, the stock price hits that price level twice, which is saying to you, it's a clue, it's saying to you that there are people supplying shares aplenty at that price level. There's a large amount of supply, and that area is now resistant to the stock price. And that's exactly what that is called. It's a level of resistance because now the stock price has identified an area of supply. And because there's a high level of supply and at that price level, it means that it's less likely, not 100% guarantee, but less likely for the stock price to break past that price level. So you wouldn't want to buy into the stock. If you see it hit a price level twice, it might be indicative that there's a lot of supply there. It may not continue its upwards trend past that price level. And you would not want to buy right below that price level because of its tendency to resist a stock price increasing. Before we continue talking about how we identify how the trend's changing here, let's go back and discuss our uptrend a little bit more. And for those of you who are curious, I'm using Thinkorswim by TD Ameritrade if you're interested. Also, you guys should follow me on Iris down below. It's an app that allows you to see people's trades and their portfolios and stuff. It's great. So you can see all my trades there. My username is In the Money Adam. Okay, something we also have to identify here is that these areas of resistance, which is when there's a large amount of supply, have the antithesis of that, which is areas of support, which is large levels of demand. You might have a range where there's an area of support where the stock price keeps hitting and won't bust through because there's demand for the stock at that price level. And then you might also have a price level that's an area of resistance because there's a bunch of supply up here because the stock price keeps hitting it and bouncing off. So then you have a stock price that's trading through a range or something called a channel. And those areas of resistance and support do not necessarily have to be sideways. So you can see that right here, there's an area of support maybe where the stock price has come down and kissed that price level a few times and it's trading sideways. We don't exactly know where the stock price is going to go because it's sandwiched between two price levels that it's having a hard time breaking through. So back here where we see our uptrend, it is traveling through something called a channel. And it's exactly what it sounds like. It's an area that the stock price rises and falls within, but does not seem to extend out of, just like water flowing through a channel. There is an average price within that channel that the stock price is trading around. It's increasing over time, but there is an average amount that the stock price is willing to go above and below. It's a regression line. There's a certain amount the stock price is willing to go up and down around this regression. So people might also look at this. They might buy and hold through this entire uptrend, or they might identify this channel and use this idea of mean reversion where things in nature, in finance, in economics, everywhere, in genetics, there's this tendency for things to revert to the average. There's a tendency in stock price to revert back down to the average, and that's exactly what happens within this channel. And so some people might look at this, and when you see it's trading at the top of the range, you might short it to the average and make money that way. Okay, so you could buy and hold. We've noticed the higher highs, higher lows. It's moving the upwards direction like a staircase. You could buy and hold and try to wait for some clues that the trend is changing before selling to capitalize and make a profit. Or you could identify that this is trading within a channel and take advantage of that mean reversion characteristic and buy when it's at the bottom of the channel and sell when it's towards the top or towards the middle. Now we have to discuss something called breakouts. Breakouts are a change in trend that are identified because they directly conflict with the prevailing pattern or trend. So in this case, we've seen this uptrend, right? We notice that it hits this price level around 186. It hits it twice. Bam right here, bam right there. That means there's supply up there. There's a level of resistance. It could be pure chance, okay? This might not be telling us anything. It could be pure chance that it hit those price levels twice, but it is possible that there's a level of supply up there that we can use as an edge. Technical analysis is so hard because sometimes things are just pure chance and you might read something where it's not. Okay, because there's millions of participants making millions and millions of trades. It can cause the stock price to do all sorts of stuff. And if you're going to treat it as a Rorschach test constantly and see truth in every single movement, then you might have some issues. You have to always take everything with technical analysis with a grain of salt. In this case, it's bounced off twice, so we've seen that the trend is no longer super strong to the upside. Then what happens? It trades within this channel. It's trading sideways, bouncing off this level of demand and bouncing off this level of supply, so support and resistance, and then we see it break through this level of demand, this level of support. When you see the stock price break through like this below this level of support, that's a very bearish sign. It means that the demand at the price level is evaporating. It's no longer there. Participants are leaving or are not interested. And you also have to keep in mind that when people are trading, when they buy stocks, they tend to set stop losses below levels of demand, below levels of support, because if there's a level of support, you want to put your stop loss below it because it has the stock price is less likely to kiss it and stop you out. So there's a bunch of stop losses, maybe, potentially, in this area. And that means if the stock price breaks below this level of demand, all of a sudden buyers just start leaving, they just disappear. Then the stock price is going to hit all of these stop losses from all the longs here who are wanting to take profits if things start heading the other direction. And it's going to amplify the amount of supply, which means it's going to amplify the amount of selling, which amplifies the downwards move. So when you see it trade sideways at this and then break a level of demand, typically people will maybe wait for a bounce and wait for it to go up to this level of demand. And when you break through that level of demand, that level of support, and it goes up and kisses it again, it becomes resistance. Where buyers once were get replaced by sellers. So in this case, it acts as a level of resistance. A lot of people wait for a stock price when it has a breakout like this to go down, back up, and test that level of resistance to see if it holds. And if it holds and starts moving down again, which it kind of did, it almost got there, and it starts moving down again, this would be a sell signal right there. You could also sell right on the break of resistance, but it's entirely possible that it just bounces clean right back up. We'll talk about all these lines here in a little bit. So that's how you identify the trend is shifting. It breaks that level of support, which now becomes resistance. And in addition to this, you can see all of these volume bars here start getting bigger. This is called momentum. When you have a bunch of participants hopping in, and you see a bunch of red candles with very high volume, it is validating this move. If you see very little volume, any move, any clue you get from the stock chart is kind of devalidified because there's not very many participants. There could be tons of people with different ideas sitting on the sidelines waiting to pounce that would invalidate whatever you see on low volume. The more participants that are there that are engaging, the more valid the move because the more information is being priced into the stock. So that would be a sell signal. And then once you see the exact opposite of the higher highs and higher lows we talked about over here, which would be lower lows and lower highs, then by golly, you found out that we're in a downtrend. In my opinion, this kind of thinking, this approach to where are the higher highs, where are the higher lows, are they there? Lower highs, lower lows, are they there? Is it trading within a channel? Are we seeing some mean reversion? Are we seeing levels of resistance and support? Do we see breakout in a test of support or a break to the downside in a test of resistance? Do they hold? Does it keep breaking out to either side? This is the type of stuff that I find the most useful when it comes to technical analysis. There's plenty more that we're going to discuss, and there's plenty more that we won't that is used in technical analysis. But this fundamental thinking of where's the trend, where's the demand and supply, how can I use this to make money? This is the most valuable information and the most useful stuff that you can use when trading based on technical analysis. And it's not always this clear. A lot of people, when they look at this, they go, this looks really easy. And it kind of is, especially in hindsight. But when you're trading with your own money, it's really hard to remain consistent trading solely on technical analysis, especially if you're trading like on the Qs to the downside. If you're trying to short the Qs, what you're doing is betting against an ETF that in general goes up more often than it goes down. If we zoom out here, it goes up more often than it goes down. Why would you bet against it? You're putting the odds against you. It's also difficult to let go of trades. There's an emotional aspect, there's a mental aspect that is hard to grapple with. And sometimes you can see too much information in the chop. But to get good at it, it just takes a lot of practice. It also just takes a lot of time just watching the markets and thinking, I would buy there, I would sell there, I would buy there, I would sell there. Just in your mind. It becomes harder when you put your real money to it, but you can start to get a feel for how stocks move the more you watch them. Now, plenty of people trade this and actually make money with technical analysis. More people don't than do, don't get me wrong. Me personally, what I struggle with the most when it comes to technical analysis, having done swing trading plenty before, is choosing the right position sizing and knowing when to exit. It's hard to know how much to leverage. It's hard to let go of a trade. It's hard to stay with a trade that's going in your favor. Like, for example, if I see this uptrend here and I'm like, screw it, I'm going to buy, and I buy right here, and then it goes down and I'm like, well, I can't take any more losses, and I sell right there, and then it bounces again and I buy right here, and then it goes down again and I'm like, oh my God, I'm so stupid. I sell right there. It goes up again. I'm like, screw it, I'm going to buy, and then it goes down again and I sell, and then it goes up again. You know, it's that kind of stuff that just rattles with your brain, and you make these very elementary mistakes. Plus, you're also trading in a way that exposes you to the short-term capital gains tax, which is a higher tax rate, which is no good. Statistically, your chances of making money solely using technical analysis are not very promising. And so for these reasons, I generally use technical analysis for price improvement, for seeing maybe intraday, 5-minute, 15-minute, 1-hour candles. Maybe the stock price is going to go down. Maybe if I'm buying a deep in the money call option, I can set the price of that call option lower, a limit price lower, because I anticipate the stock price is going to drop, which is going to reduce the value of the call option, so I can buy it at a cheaper price. Generally speaking, okay, I'm not sticking myself super hard to any rules here, but generally speaking, that is what I use technical analysis for, is price improvements, because there's a lot less stress in that, and you still are benefiting a lot by improving the price of a call option by $500, for example. Okay, so what we're looking at here, when we're talking about higher highs, channels, mean reversion, and trends, and all that is price action. We are looking at how prices move through the lens of candlesticks and using that to determine our buy or sell decision. This is the most valuable information you can use when trading via technical analysis, in my opinion. But there's also something else we have to discuss, which are indicators. This was part 1 of a 2-part video. So if you want to see the next part where we talk about technical indicators, you can click the arrow next to the buffer bar, or you can find the second part in the description below.